day, everyone, and welcome to this SSQ investment webinar. Let me introduce myself. I am Luc Bassé, Vice President Business Development for Central and Eastern Canada, Individual Insurance and Investment. We are happy to offer you today this review of the financial market over the last quarter, along with a brief review of our CI Corporate Bond Fund, as well as our CI Signature Global Income and Growth Fund. Before introducing our guest speaker, I want to let you know that we have time. If we have time at the end, we will answer one or two questions, which you can ask via the Q&A section of the webinar site. Your SSQ wholesaler or anyone from the sales team can also assist you with any unanswered questions. We'd also like to take this opportunity on behalf of our National Vice President, Doug Paul, and on behalf of the entire distribution team and myself, to thank you for your trust and your business in 2017. I wish you all lots of success in 2018. Without any further ado, let me introduce our two guest speakers. First, Mr. Daniel Conti. Daniel has over 16 years of experience in the financial industry and has joined CI in 2006. He is responsible for the business development and the services of the institutional clients. Prior joining the institutional group, Daniel acted as a fund manager for a private wealth group and as an investment analyst. With Daniel today, also Mr. Jeff Marshall. Jeff is Vice President, Portfolio Management and Portfolio Manager. He heads the corporate bond team at Signature Global Asset Management. Mr. Marshall has extensive experience analyzing, managing, and trading high yield bonds, convertible bonds, and leverage loans. He is the lead manager of Signature IAL Bond Fund and co-manager of the Signature Corporate Bond Fund and several diversified income funds. Funds co-managed by Mr. Marshall have won 4 Morningstar Awards and 10 Lipper Fund Awards. He joined CI in 2006 from Manulife Financials, where he was a portfolio manager. Mr. Marshall holds a BA from the University of Western Ontario and the Chartered Financial Analyst designation. So on this, I'll give the floor to Daniel. Thank you.
Thank you for that wonderful introduction, Luc. Thank you, everyone, for attending today's call, wherever you might be. For those in earlier time zones, thank you for joining quite early. As Luc mentioned, my name is Daniel Conti. I do cover Eastern Canada and wanted to ensure that everyone was aware of the strategies that we have with SSQ right now that are two important strategies for CI, and being offered through SSQ as a partner is truly has been a wonderful experience over the last 3 years. So the two strategies are global income and growth, one being our most balanced strategy, really the strategy that is the best of all ideas from our Signature Global Asset Management team, as well as our corporate bond strategy, which is certainly a great diversifier for traditional fixed income, given the current markets that we find ourselves in. And as Luc mentioned, we have the pleasure today of having Jeff Marshall, who is lead port manager, co-lead on the global income and growth, and also co-lead on the corporate bond strategy. Unfortunately, Jean-Philippe Brie, who was supposed to be on, had a scheduling conflict, but having Jeff as a primary member of our credit team and also a committee member of our tactical asset allocation team is very important. So Jeff will take us through our Signature team philosophy and then provide a review of the markets with a focus also on the current fixed income markets. And I believe with that, I'll hand it off to Jeff to get us going. And thanks again.
Thank you, Daniel. Thank you, Hugo and Luc. Thank you for inviting me to speak to you this afternoon. I'd like to cover off 3 things this afternoon. I want to talk about the Signature model. I want to talk about how we see the world and market opportunities and our economic outlook. And I want to talk to what we would invest in, or what we are invested in, and how we think you should be positioned going forward. So next slide, please. I think managing money comes down to culture. I think everything comes down to culture. as we've been building out Signature, I've been here since 2006. Eric Bushell, our CIO, is building out Signature for the last 20 years, really facing the challenges of the markets being incredibly interconnected. You know, what you are learning in the credit markets, does that apply to the stocks that you're picking? Does your interest rate call influence your currency positioning, influence what you might be inclined to do on the commodity side? Markets incredibly interconnected. The markets are global. The Canadian market's a small part of the global market, and the markets are incredibly complex, too complex for a generalist portfolio manager picking bank stocks, Canadian bank stocks, and then having an informed view on Google and Facebook. So we adapted at Signature these 4 core philosophies. We want to run a global fundamental sector specialist model. We're committed to this cross-asset intelligence or collaboration between asset classes, committed to constant improvement, and committed to helping our clients. I think that really is the culture. Next slide, please. I think it's important to marry the culture with dedicating enough resources to managing money. And this is the Signature team. This is the 50 some odd people at Signature running equities, running high yield bonds, running investment grade and government bonds, helping us with our currency calls. This is our asset allocation committee. This is, I think, what it takes to run $50 billion globally successfully. And I think this team is staffed and resourced to handle $200 billion. Next slide, please. Because as I think about resources and scale go hand in hand. I look at some of the pieces of or segments of the assets that we own, and it occurs to me that Signature high yield bonds or Signature equities are the same size as some of our competing fund companies in Canada. And this is all relevant because your scale, your resources, they drive your relationships with companies, with issuers, with underwriters that sell bonds and equities. And you want to be relevant to their business. If you're relevant to their business, you get better information flow. You can turn that information into better returns for your clients. Next slide, please. So it occurred to me that there's an equation for how to build a successful fund management company. And I think you start with culture because culture trumps strategy. But the right culture, and at Signature we have a no jerks policy. You can be the biggest and brightest, invest in stock picking in your sector. So if you don't play well with others, if you're not willing to share your ideas around the table, you're not going to last at Signature. So it starts with culture, buying into our model. You need resources. You need scale. You combine those 3 elements and you get the access. You get the access to issuers, to underwriters, and that access creates a relationship. And this is a relationship business because we're looking for information. We need to take information, turn it into conviction, turn that conviction into performance, that performance going to funds that you can build a practice around. So I think about this equation for building a successful fund management business. This is where Signature is. I think a lot of our competition is not there, lacking scale or lacking resources. Maybe some larger firms actually lacking culture, to be honest. I think we're there. Next slide, please. So how do we apply that model to managing money? Well, as we think about where we are in the business cycle or the credit cycle, I think the business cycle is traditionally thought of recession becomes recovery, becomes consolidation expansion, becomes overheating exuberance. And it's very linear. In our mind, no, it's more than that. It's growth versus decreasing growth, increasing inflation versus decreasing inflation, and various fiscal policies, monetary policies, trade policies that can push risk sentiment in the markets to different parts of this chart. And so at Signature, we're always listening to the companies that we're involved with. We're always listening to the market levels, correlations between different asset classes, commodity prices, and trying to figure out where we are on this chart. And if we can figure out where we are on the chart and where we're going, we can figure out actually how much risk we want to take in the portfolios and what kind of risk. Do I want to take interest rate risk because I'm feeling very, very cautious? Or do I want to take equity risk, which is where we are now, because we're actually feeling like things are okay, and it's the light is green. We can drive safely with caution, which I think is consistent with how Signature manages money. But we're generally seeing a green light in the markets right now. Next slide, please. And this is how we feel the investment cycle has turned really since 2003. This meandering line between growth decreasing, inflation decreasing, and growth actually decelerating. So each successful peak in growth lower than the last. And it was in 2016, Q3 2016, that we said, no, this time is different. We're confident saying that quantitative easing works. The billions of dollars, trillions of dollars of government bonds and mortgage buying by the Fed, by the Bank of Japan, by the European Central Bank has pushed interest rates low enough, government bond yields low enough, asset prices high enough that it's instilled a real sustainable confidence in the markets. That market confidence can become real economy confidence, and we can see real growth in the markets. In that environment, we want to take more risk with the portfolios. And it was really in 2016 where in funds like our Signature Global Income and Growth Fund that we took our equity weight up pretty dramatically, our cash weight down pretty dramatically, our gold weight out of the fund, and you'll see that I'll speak to this later in the presentation, it's reflected in the performance of the fund. So as a member of the Asset Allocation Committee, I contribute to trying to figure out where we are in the cycle. We're not always going to get it right, but I feel like we have a head start at Signature because of the Signature model and the resources that we have, in terms of dedicated macroeconomic strategists that really all they need to do is figure out kind of where we are in this cycle. Sector heads in different asset classes that contribute to this discussion. So I think it's a unique top-down in terms of very much a lot of listening from the macroeconomic side and a lot of bottom-up stock picking and bond picking that contribute to the Signature model. Next slide. So some of the things that we listen to figure out where we are on that chart. Like I said, we take our cues from many different asset classes. This is a financial conditions index. It looks at borrowing costs. So, for example, high-yield bond spreads, emerging market bond spreads, the ability of companies to borrow, the willingness of banks to lend. Volatility goes into this. But I think you can quite clearly see that really since 2008, financial conditions have improved dramatically. There's a little bit of a hiccup or an air pocket in 2015 with U.S. dollar strength, commodity weakness, particularly in energy, but we're through that. And I think we're actually pretty confident in saying QE worked. So we're on to the next thing, and I'll get to that in a second. Next slide, please. This is Global Purchasing Managers Index, so an indication of corporates, companies' willingness to spend and reinvest back into their business. All lights green. In our opinion, synchronized global growth for the first time, I think, since 2011. So global financial crisis over, QE worked. Should we be worried about inflation? Maybe a little bit at the margin, but it's not really at the top of our list of things to be worried about. There's still a lot of deflationary pressures in the world, and really since 2008, the central banks have been fighting deflation more than anything else. Globalization, deflationary, in terms of lowering in North America, for example, or in Europe, for example, the cost of human capital. The same thing applies with technology. Demographics, I think, are deflationary as more consumers save and need more of a fixed income. And I would actually say deregulation is deflationary, but in a good way, in terms of removing cost to business. So I think this begs the question, with global synchronized growth, with purchasing managers looking to spend money and reinvest back in their business, with unemployment falling, will higher interest rates globally and the end of Fed and ECB asset buying programs collapse the housing, the bond, or the equity markets in 2018? And our opinion is no. Which rates are rising? Well, if you think about Canada and the US, the front end of those government bond curves, the part of the market that the Bank of Canada and the Fed actually control, the overnight rate, that's come up 50, 75 basis points in 2017. But the long end of the curve, where companies borrow, where mortgages are indexed off of, in some cases, those parts of the curve where borrowing costs have actually fallen. So how high do rates have to rise? Or how high can rates rise before we start getting concerned? And we're actually not that concerned about rates rising to the extent where they impact the economy. We feel like there's enough indebtedness in the global economy. There's a lot of indebtedness in Japan. That rate structure is not moving very much. There's indebtedness at the government level in the US. There's personal indebtedness in Canada. We feel like long rates, particularly the 30-year rate, is probably capped at about 4%. Goes much higher than that, it will very much have an impact on growth, and we feel like the bond market will respect that and keep that rate below 4%. Short end rates anchor the long end of the curve, and the Federal Reserve has actually projected 3% as the long-term neutral short rate. So you can think about 2006, 2007, short-term rates in Canada, the United States, 4.5%. Good GIC rates, a place to hide if you're worried about the equity market. We don't think we're seeing that. We think, even the Fed thinks, 3% might be the new long-term neutral rate for short-term rates. Next slide, please. So our market outlook, again, we don't really see risks from the economy. We see GDP growth better than expected almost everywhere. U.S. tax cuts will be only additive to that growth. And again, probably tepid inflation. Things we are worried about are more political, whether it's trade policy, NAFTA, particularly as it relates to Canada and Mexico, China, in terms of can they continue to engineer a soft landing? Can they make the necessary reforms in their economy that they need to do? And then I think as we get into mid-year, more of the rhetoric around the midterm elections and what that could mean for the legislative agenda in 2018 and 2019 in the U.S. So we're still in a view that we're in this lower for longer environment for some time. So that's lower inflation, lower interest rates for some time. We don't think holding bonds hurts you too much. And when I say bonds, I mean government bonds, Government of Canada bonds, U.S. Treasuries, maybe down 2 to 4%. But really, if growth is going to work, if equities are going to work, that's owning bonds is the offsetting asset in your portfolios. You kind of want -4 to -2% in bonds in that kind of environment. These two asset classes are supposed to offset each other. We think equity valuations are okay until short-term interest rates or investment-grade bond yields get to 3 or 4%. So until investment-grade bond yields or short-term interest rates get to 3 or 4%, where they actually start competing with equity valuations. And again, we're not there yet. We would be buyers, and we will be buyers, of government bonds as yields continue to back up. We don't need to swing for the fences in funds like the Signature Global Income and Growth Fund. We just need to pivot for safety as valuations get a little bit more expensive. We see favorable conditions for EM assets. The Canadian consumer is at risk with a heavy floating rate debt load. Now this favors foreign equity markets and currencies, but it actually would be positive for our bond market. So the title of my presentation was The Next Thing, which is we see the conditions in place to quite confidently say the global financial crisis and its hangover is over. The hangover is over. So what's next? Well, a couple of things that unfortunately are hard for us to quantify their impact on the market or the economy. One of them is decarbonization. We see large pools of capital looking to get away from heavy carbon-intensive oil and gas. That can be a market negative for Canada. We see China moving up the value chain, what we call China 2.0, where previously China and parts of Asia were where you would move low-cost manufacturing to arbitrage the lower cost of human capital. I think that arbitrage is disappearing. China's moving up the value chain in technology and clean energy. Huawei, for example, spends more on R&D than Apple. In 2016, e-commerce in China was $752 billion, US dollars, about 2 times that what it was in the United States. China is the largest manufacturer of electric vehicles. 2/3 of the world's solar panel production capacity is in China, and China is home to 28% of the world's renewable energy capacity. So technology, clean energy, China is very much emerging as the global leader. No coincidence that Signature has an office in Hong Kong. We've had one person there for the last 5 years, and in 2017, we added 2 more people there, 1 trader, so we have a full-time trader in Asia, and 1 more analyst. Another thing that we're thinking of, the rise of populism, whether it's politicians like Donald Trump on the right, Jeremy Corbyn on the left. Hard to quantify the market impact, the economic impact of fiscal, monetary, trade policy, foreign policy changes. Something we're paying a lot of attention to, but again, hard to quantify. And then the fourth thing I want to speak to in terms of disruption is digital disruption, whether it's blockchain, which aside from the speculative value or worth of things like Bitcoin, I think blockchain as a technology is interesting. I think it's going to be transformative. But digital disruption, I think, also applies to cloud computing, which is very much dramatically lowering the cost of computing. It speaks to AI and big data and its impact on jobs and sectors. I can think of, for example, robo-advisors. How's that going to impact our businesses? And then I also think about things like online retailing. Companies like Amazon. Next slide, please. I thought this chart was just too good not to share. So this was the market impact on June 15th, 2017, when Amazon announced it was buying Whole Foods. This is Amazon going from online retailing to dipping a toe into owning bricks and mortar retail. And so on the left-hand side on that axis is the percentage drop in the share price of these companies, and the size of the bubble represents the market capitalization lost by those companies. So for example, Walmart was down, call it 12.5% that day, losing $17 billion worth of value. Amazon is a disruptor. And we want to make sure at Signature we can benefit from that, as the case may be, but we also want to very much make sure we don't get hurt by digital disruption. Next slide, please. So I've articulated how we see the world, where we see the opportunity set. It is go for growth. It is own equities. But I want to walk you through a couple of examples that you'll find in the funds. In this case, both Signature Corporate Bond and Signature Global Income and Growth. They're high yield bond examples. That's the market that I live in. And I think it should give you a sense of how we do things at Signature and how we see the world. So one of them is Vertiv. Vertiv is a pretty boring little company. It was spun out of Emerson Electric in a leveraged buyout. So the bonds that we own finance that leveraged buyout. They're a provider of thermal management, AC/DC power systems, transfer switches, and information management systems for communication networks, industrial markets, and this little niche part of the world called data centers, which just exploded in 2017. So this is very much levered to that digital disruption I just mentioned, because data centers allow companies to cloud compute. They allow the co-location of servers and data storage facilities for additional redundancy and security. So when this financing came to the market, the high yield bond market had never seen a company like this before. Is it technology? Is it industrials? It didn't have an operating history because it was spun out of a larger company called Emerson Electric. We looked at the term loan. the term loan on a senior secured basis at 5.5% looked pretty attractive to us. And the bonds at 9.25% actually looked very attractive to us. We saw a company that could benefit from this data center. As more and more data centers are built out, they could benefit from that, and they could de-lever their balance sheet. They could pay down debt, which benefits us as shareholders, as lenders. And so what happened actually was a little bit more fortuitous than that, which the company sold a small business that they had bought as part of Vertiv. They sold it, they took the proceeds, and they wanted to pay themselves a dividend. Now, at Signature, we spent a lot of time understanding what we've lent to and the conditions around how we lend to these companies. And there was a bond here that wouldn't let the private equity sponsor, the owner of Vertiv, pay themselves this dividend. That's great. Why do I want that leakage to shareholders when it should accrue to lenders? And so we came into an agreement with the equity holders. You pay us 7.5%, and I'll let you pay yourself a dividend. So here, owning the bonds, I've got 1 point of price gains in 2017 owning this bond as the credit quality improved and the yield lowered, so the price came up. I earned about 9 points just on interest with the bond, and then 7.5 points on this consent fee, this one-time payment to allow them to pay themselves a dividend for a 17.5% return in this very boring industrial/tech company. We can do that at Signature because when it comes to market and it falls in between sectors and it doesn't have an operating history, I can work with my equity team and try to get a sense, how big is this opportunity in data centers? When the answer comes back, it's big, I can be quick to respond. Next slide, please. The other example might be a little bit more familiar to you, and that's Canada Goose. Canada Goose is transitioning its business from being selling through retailers like Harry Rosen, like Sporting Life, to trying to move more of their business online and capturing more of the margin themselves. And that requires some investment. And so prior to the equity IPO being done, the company was trying to pursue this investment. So they took a bank loan from some corporate banks, including Credit Suisse. And Credit Suisse and some of the Canadian banks extended this loan because they wanted the IPO business. They wanted that trading volume that goes with selling the shares. Once that IPO was done and Signature participated in the equity offering, the banks were now sellers of this loan. They were sellers of this loan because it's not rated. And the amount of capital the bank has to hold against an unrated, being unrated by Moody's or S&P, not having a credit rating, is too exorbitant. So it's too expensive for the bank to actually be a lender to Canada Goose. So then they look to offload that loan into the market. But it's not rated. So it's not rated, so it's not in any index. So the potential buyer base of this loan for Canada Goose, LIBOR plus 400 basis points, so right now that pays about 5.7%, goes from a couple of thousand down to maybe a dozen. So Credit Suisse contacted 6 buyers for this loan. It's only $150 million in size. They contacted 1 investor in Canada, and that was Signature. So Signature is actually now the largest lender to Canada Goose. We already own the stock. We could look at it quickly when Credit Suisse called. We got that call from Credit Suisse. Think about my earlier comments, because we have a relationship with them. We have scale. We have resources. This is an information business. It's a relationship business. I think here's an example where the Signature model was able to deliver a position into our portfolios that very much drove value. Next slide, please. So there's a couple of examples of how we think of the world and how we try to pick bonds to drive value. What should we own going forward? To my earlier comments, we think the craft light is green for growth, for owning risk. We want to be overweight equities despite valuations. We think growth continues to outperform value and probably outperforms the income asset classes within equities like real estate as well. Credits, we feel like we are later cycle. It's fully priced in but supported by the economy. Returns are probably lower in credit, both investment grade and high yield. Lower in 2018 2018 than they were in 17 and 2016 because valuations are higher. But I think both high yield and investment grade are supported by tax reform. Particularly, interest deductibility is going away. So the ability of companies to deduct interest expense to reduce their tax burden, that's going away. That raises the after-tax cost of debt. I think companies at the margin will reduce the amount of debt that they run with. FX, Canada, the Canadian dollar is probably range-bound. The Canadian economy lacks competitiveness versus the U.S. Higher rates will impact the mortgage market and be a drag. Regulation in the mortgage market will be a bit of a drag. And then there's a bit of a wild card with NAFTA. But overall, we're constructive on risk. We think 2018 will be a good year for returns, not a great year, given valuations. And as always, we have an eye on risks and potential air pockets. Next slide, please. So that was what to own. Well, how should you express those views? And so I've got two suggestions for you, of course. One is the Signature Corporate Bond Fund. This is a fund, half high yield, half investment grade bonds. This is my favorite chart of all the charts that I've ever put together at Signature. And I call it living above the efficient frontier. Because what we've done with this fund over the last 10 years, I'd love to do over the next 10 years. So if you look at this chart, the Signature Corporate Bond Fund has essentially generated the same return as the high yield bond market, but with the risk or the volatility of the Canadian bond market. That's that purple triangle. But it's not a high yield fund. The most high yield this fund has held over the last 10 years is 65%. So it's a much more efficient fund than its underlying asset classes, which is my point. We live above the efficient frontier. Over the last 10 years, it's outperformed 72% of its peers. But again, it gets lumped into that high yield bond category by Morningstar, by Globe Fund. It's not a high yield fund. I think it's a very attractive offering to continue to benefit from corporate bonds outperforming rates or government bonds in 2018. Next slide, please. Give you a sense of how we're currently positioned by portfolio yield, by duration, by sector breakdown. I said it was about 50% high yield, 50% investment grade. It can go 0% high yield. Probably the max we'll ever own is 70%. Currently, we're about 38% high yield. Call it 6% loans and floating bonds, 4% private placements, 13% investment grade prefs. This is like Credit Suisse, UBS, Goldman Sachs, Bank of America, Citi. So these are fixed floating prefs. 36% in straight IG and 3 points of cash. So that's a lot, but my point is, if you look at this fund and say, well, I can do that, I can do it cheaper with an ETF strategy, 50% high yield, 50% investment grade, that's great. No, you can't. Because I look at the active share of this fund, it's about 80%. Put that another way, there's only 20% of this fund that looks like the underlying index. This is how we add value. We add value by not looking like the index. Next slide, please. We've been pretty tactical over the years, changing that asset allocation, the high yield weight versus the investment grade weight. It's credit risk versus duration. That high yield weight's been as low as 25%, and that was in 2008. Should have been 0, but it wasn't 50%, it was 100%. Next slide. Actually, let's go to global income and growth on the next slide. This is our go anywhere, global balanced. Hand the asset allocation decision over to Signature. I trust the Signature philosophy, the Signature resources, the scale, the capabilities of Signature. I want to hand that decision over to Signature. Essentially go anywhere. We probably are right now our max equity weight, so call it 70, 75%. But we always have that duration leg, that interest rate risk in the portfolio as a mitigator. Next slide, please. And this is actually how we've changed the asset mix within Signature Global Income Growth over the last 5 years. You'll see in 2016, as I mentioned earlier, we got risk on with what we viewed as a fundamental regime change in the markets, that QE had worked, that virtuous cycle of what that is confidence. That confidence begets confidence in the markets was real and was going to hold, that the central banks were not going to derail us by acting too quickly, rising rates. We got the equity weight up. We got the gold weight out of the fund. We got the government bond weight down. We got the cash weight down. We got some EM up. And in 2017, the representation, that trade was kind of changed at the margin a little bit as we took the high yield weight down about 3 or 4 points in favor of owning more equities. And again, another trade that worked well in 2017 in terms of driving returns. Since this slide has been built, you can actually see it a little bit on the right-hand side. We've added just a couple more points of gold to the fund, owning gold in lieu of owning government bonds, and that's a trade that's worked so far in late 17 and early 2018. So 1 minute left really for my conclusion, which is partner with the right team. Partner with the right team that has the culture, the right philosophy, resources, and scale that can drive relationships, access, information that drives performance, that creates funds you can build a practice around. As it relates to the markets, we think it's go for risk, cautiously, as always, prudently, but I think owning equity risk and to a lesser extent credit risk will pay off in 2018, where bonds probably don't hurt you too much. And then Signature Corporate Bond Fund to express that view in credit, and Signature Global Income Growth Fund to express that view in credit and in equities, I think are the way to go in 2018. And at that point, I'm going to say thank you very much for listening, and hopefully we have some questions.
Yeah, so we've received a few questions from the participants. We won't be able to answer all of them, so I'll start with the first one. So what do you think of NAFTA renegotiations, and what will be the impact on Canada and Canadian equities?
That is like asking me to read Donald Trump's mind. I think fundamentally the trade agreement will change. The Trump administration seems to be in favor of bilateral trade agreements instead of multilateral trade agreements. I think that goes to his view of playing different parties against each other. I suspect we're actually talking about NAFTA this time next year. That it becomes a midterm election issue. That it possibly survives, but it just remains a political issue through the midterm elections. I can't hazard a guess as to the impact on the economy. It would be substantial in the near term. The supply chains in many markets are very much interconnected, especially in autos, for example. Some auto companies actually might just decide to incur the import tariffs and import into the United States as opposed to building cars completely in the United States. Canada would need to develop trading relations and markets, in new markets, and that takes time. And probably the immediate adjustment mechanism is probably the Canadian dollar goes lower. And which is one of a few reasons why we're not completely hedged on our U.S. dollar exposure in the funds. Where should NAFTA negotiations go poorly, that should be an offsetting position in the funds owning some U.S. dollars.
Great, thank you. So what do you think of the U.S. tax bill that was just signed, and do you think the market has over or underreacted in regards to stock valuations?
It feels to us like the tax reform bill, the implications are not fully baked into the market, not yet. Like I said, there's impacts on the corporate bond market. So we've got interest deductibility going away. Companies will be able to immediately expense capital expenditures, so it encourages companies to spend and invest back into their business. One of the big ones is foreign profit repatriation at a lower tax rate. So Apple, for example, bringing back $150 billion $150 billion of foreign profits sitting overseas. It was just kind of idle cash. I think Apple's actually the largest corporate bond manager in the world. I think that's positive for M&A. It's positive for more share buybacks. It's positive as more of those share buybacks are funded with cash, and we see fewer investment-grade companies funding those buybacks with the corporate bonds. So I think you see less corporate bond supply. And then the big one is the lower corporate tax rate, which will increase cash flows. And so to us, despite valuations in the equity market that seem full, despite kind of a sustained rally in equities, it still feels like it's not baked into the equity market or into the corporate bond market. The challenge will be on Canada, I think, to respond with a lower corporate tax rate just to remain competitive.
Thank you, Jeff. That's all the time we had. So thank you, Daniel and Luke, for your time. It was very interesting. To all who have listened to the webinar, thank you for your participation, and come back in February as the Fiera Global Equity team will discuss the fund's performance and positioning. Have a great day. Thank you.
Thank you.
Minutes, 41 secondes.
OK. Je voulais juste voir ça enregistrer. Oui, ça enregistrait.
Ça l'enregistrait?
Ça l'enregistrait.